All right, for more on today's rally and what Trump's latest tariff moves mean for the markets, we are joined on set by Ben Emons. He's a senior investment executive at Strategic Fortune Wealth and founder at FedWatch Advisors. Ben, great to have you with us. I don't know if you have recession data at your fingertips, but what do you think the market is pricing at this point? Where are we in this rally?
So it was really amazing, this conference number today, right? Where, in that number shows that people expect about stock prices. There's now, people think 44% of that survey said that stock prices will be going up in the next 12 months. That was 35% when we were during the whole tariff, the market we went through. So there's a big shift happening there, that people suddenly getting confident that as we're putting these tariffs off, that's really what this all was about. There's a confidence crisis that we had, and we're reversing that. And the markets, as you say, Guy, has already rallied ahead of that confidence. So what you're going to see now is that the survey data really were hit, were like consumer confidence, or what you had the Dallas manufacturing survey showed a similar sort of effect. That gets affected just by the tariffs and now starts reversing. This is only going to drive the markets even higher, because that's really what the data was impacted by, as opposed to the hard data that's not showing any effect.
Are you a believer in the rally? I mean, you say that all these things are positioned, are in place for the markets to go higher. But is that what you, Ben Emons, believe will happen?
I think it will, because one is a good technical picture that's changed. I think to Guy's point, we bounced off the 200-day moving average in a really nice trending sort of channel on the NASDAQ, as I've been tracking that particularly, points really to the upside. But what is encouraging is that if we do get to a stance here between China and the US and Europe and the US, which is the biggest part of the trade war, sort of getting to a point of like, there's this deal in the works and it stays that way, then there's no reason why markets couldn't go higher. So I think that's convincing, because we do not have an economy, as you say, is in a recession. It may have been a confidence recession that we had briefly, but that was so small, it didn't really matter. So I think there's much more upside.
Well, I'm sorry, go ahead, Dan. No, you go ahead. No,
wow.
Please.
Ben, if I told you since 1945 we've had 12 economic recessions, that's 79 years.
Wait, hold on a second. How did you come back so definitive on your recession data?
And you divide it by 12, you get 6.6.
Huh? See what happens on this desk, Ben?
Yeah, average.
I can tell. I mean,
on the perplexity like that. So you guys are getting all my grill.
Afraid. Yeah.
So we've extended, what do you call it, Guy? We've alchemied out recessions, okay? But what's different is we do have 4.5%. So we haven't had a recession going back to COVID. Let's get rid of that one. Like, what does that mean? Like, the markets were obviously sniffing it out. We didn't have it this time around. Who knows what's going to happen? Will the market start to figure this out if we start getting hard data that kind of shows that things are weakening a bit?
Well, what I think matters there, Dan, is that the trade between China and the US was put on hold, was frozen, was an embargo, which is a big deal for GDP, right? If you actually keep that in place, I would say your recession call is right. We would be in a recession. But since we started slowly restarting it, and it seems to be the case, you can kind of tell from China data too, that I think is the big data point we should be watching. If there's indeed more weakness coming through that we didn't know of, you can maybe make that call that at least the economy got a lot weaker through this whole episode. So that doesn't seem to be the case. There's no, I think, financial indicator giving us the signal of a recession of any kind. It's really that data, the trade data between the U.S. and China. Yeah.
Last week, Japan had one of the worst bond auctions since 1987. Our yields were going up on the back of that. Dollar-yen was seemingly going to test 140. Tim mentioned a lot changed over the weekend, but is that fixed or just sort of pushed off a little bit?
Amazing how they overnight started sort of verbally intervening in the JGB market. That's actually the first time I've seen it in a while. There's always a dollar-yen that gets that verbal intervention attention. We got that auction tomorrow. There may be some short covering going on here, just to try to get out of the way. But the fact is that Japan has an inflation issue. It has a food price crisis. And it's, I think, partly driven maybe through the tariffs, partly maybe driven just through the domestic situation, that the Bank of Japan cannot keep the hikes off the table. So this is, I think, a very temporary situation. I would not think that these yields are going to go much lower from here. And if we're getting more relief from this trade war, as in, if it further fades away, the economy gets more relief here in the U.S., just in itself drives up yields and will drive up JGB yields.
Do you expect yields here to remain tame?
No, actually, I don't. I think what we experienced in the past...
So we will rally with rising yields?
I think so. I think it's really a function of... We had this volatility in April, and there was this whole debate about Powell, too. I think that had an impact on rates. As we're getting out of that and you get this relief on the economy, so to speak, then, yeah, you're getting this good news idea. So you would see higher yields and higher stock prices. I think that's where we're going.